Hello and a warm welcome to Talking Stocks. I'm Gugulethu Cele. In studio with me is Sean Ashton and Henry Biddlecombe, both from Anchor Capital. Now today we're talking JC listed Famous Brands, Africa's leading quick service and casual dining restaurant franchisor with a footprint spread across South Africa, Africa and the United Kingdom. Gentlemen, thanks for joining us as always. I think Famous Brands is one of those companies that you just cannot not interact with. At some point in your life, you either have a cup of coffee, a pizza, or a burger from one of their stores. But let's put this company into context with regard to its size and some of its key characteristics and brands.
Certainly. So I think from what was originally the Steers Holdings, this has become a much larger business over the last 10 to 15 years or so. We've now got a company that's making operating profits of about 800 million rand. It's a really sizable business. And for me, Gugu, the real attraction of something like Famous Brands, it's one of the most wonderful companies on our exchange. And the trick to this thing is that they're able to grow their profits without utilizing their own capital. If you look at the makeup of the group, you've got a franchising division, you've got a manufacturing and distribution division, which is increasingly backward integrating into their franchise brands. So the brands that they own, that they franchise out to third parties to run the stores. They are increasingly supplying more product to those stores and hence earning a margin there. That's been a deliberate strategy for a number of years now. But if you look at the core franchise business, which is about 50% of their profits, exceptionally capital light, because you're ultimately you're not the owner of those stores, you own the brand, and you're charging probably a 5 to 7% franchise fee for the restaurant owner to operate under your brand. So you're collecting that fee at head office, and there's comparatively little costs associated with that income. So you're making a 60% operating margin on those profits. And in order to grow those profits, you don't have to use your own capital because you have more people coming to apply to open stores, and you charge a percentage of turnover. So it's the most wonderful business.
I'm glad you mentioned that because that's potentially the differentiator between Famous Brands versus the likes of Grand Parade Investments, of Burger King and Taste Holdings, which have bought in Starbucks and Domino's Pizza.
Absolutely. So in all of those other cases, you've got a situation where these guys have been appointed, in the case of Taste and Grand Parade, they've been appointed the master franchisee for a region. It might be South Africa or Sub-Saharan Africa. But in all instances they're not the owner of the brand. They're operating somebody else's brand. They own the restaurant, so it's capital heavy. But more importantly, they have to pay a fairly sizable share of their turnover through to the ultimate franchise owner in the US or wherever they are. So it's inherently a more capital intensive, lower margin business.
Coming back to Famous Brands though, looking at the charts, it does seem as though there's strong revenue growth if you look at the growth on average over the last 5 years. It's quite substantial and double-digit growth that we're seeing here, Henry.
Correct. So, I mean, they've got a fantastic growth track record. If you look over the last 5 years, revenue's grown at a compound annual growth rate of around 20% per annum. And impressively, despite investing in vertical integration and a huge amount of marketing, they've been able to maintain their operating margin at a level of around 20% as well. And that's really translated into earnings growth of around 17% per annum over the last 5 years. And you've been rewarded to be a shareholder. You know, if you've held Famous Brands shares for the last 5 years, you've earned a compound annual return of 27% per annum, for 5 years. And that's without dividends. That's just capital growth.
Is this sustainable though? Because my question would be, with the macroeconomic conditions of slow economic growth and consumers not spending that much anymore, that maybe these numbers might be slightly under pressure. Is that a bit too far out?
Well, look, you've essentially got two components to the business, at least customer-facing parts of the business. You've got your quick service restaurants, which is like your sort of your debonaires and your steers, which cater to your LSM 4 to 7 client base. And then you've got your casual dining brands. And on the lower end of that spectrum, you've got your Wimpies and your Mug and Beans. And on the higher end of that spectrum, you've got your Tashas and your Turns and Tenders. And they cater to the LSM 8 to 10 customer space. Now, what Kevin Hedderwick was saying is that they are starting to feel a little bit of strain coming through the quick service brands. The LSM 4 to 7 consumer is under pressure at the moment. They're facing heavy inflation and wage growth is starting to slow. So they're actively trying to shift the revenue mix in favor of your higher end casual dining brands, which cater towards a more resilient consumer. And there are really two primary ways that they're doing that. So one is on a local level and one is on an offshore level, which we'll discuss later.
But I think there's another aspect to it as well, which is worthwhile mentioning, and that's where the benefit of scale comes through, especially where you're backward integrated. Is firstly, you've got to make sure you've got relevant brands, and you tend to find that in tough times, people go to trusted brands, and you might find that less relevant brands lose market share. So I think there's a case to be made for them gaining share within most of their core categories in tougher conditions. But more importantly, if you're backward integrated, you have the ability to manage the price points at a menu level for all of these brands to the extent that you can control an element of the supply chain. So you can choose to take a bit of a margin squeeze on your back end in terms of manufacturing and logistics in order to support the franchisees and ensure that they don't lose share and that they can maintain menu prices that are appropriate. So I think it creates quite a lot of flexibility for the group, which smaller non-integrated players might struggle to achieve.
If we do focus on the companies that they do have locally that you alluded to, Henry, on the higher marking of the LSM groups, looking to roll out quite a few stores here from 2,600 plus minus and looking to expand even further on that end. Give us some analysis on some of these companies here.
Okay, so look, they've got a store footprint of around 2,600 stores currently, and they're targeting another 290 stores in FY17, so substantial store growth of around just north of 10%. But what they are doing is they're taking a 51% stake in premium brands, which they feel they can scale. So 5 examples of those that they've recently taken are Mythos, Salsa Mexican Grill, Turn and Tender, Lupo Osteria, and Catch. Now, between those 5 brands, you've got about 20 restaurants, and they're looking to grow that to around 150 restaurants over the next couple of years. Also with Tasha's, I know that they've recently opened one in the UAE, in Dubai, and apparently that's doing very well. So they're looking at opening another 2 to 3 there.
Internationally as well, Gourmet Burger Kitchen in the UK. I was a bit nervous about this acquisition because after Brexit, we're still not sure what might happen, but sounds like a very substantial deal here that can add to the earnings substantially so over the next few years.
Absolutely. So I think one of the things that I've been a little bit skeptical of in recent years is that it's appeared that Famous Brands has been doing incrementally bittier deals in terms of the types of brands that they've been acquiring, stuff that doesn't always necessarily require a detailed SENS announcement, but creates quite a complex portfolio. Now, this transaction has changed that a bit in the sense that it really does move the needle. It's a £120 million enterprise value for 75 restaurants in the UK. We understand they make close to £10 million of EBITDA, so they've paid about 13 times EBITDA, not very low. But it seems that the opportunity to scale this brand is certainly there in the UK, and I think we wouldn't be surprised if they double that footprint over the next 4 to 5 years or so. And our understanding is that they want to achieve or scale up the profits from circa £10 million at the EBITDA level to about £30 million over a 4 to 5 year period. Now, if they achieve that, this transaction alone, net of the interest costs associated with the debt financing, we estimate will add about 5% annually to earnings growth over the next number of years. So if you've got a business that organically we think can grow at 15% per annum, this adds another 5%, you're kind of up at 20% potentially in terms of earnings growth.
That's quite huge. Is this perhaps their first foray into international markets and really diversifying the income stream where there might be a benefit from a currency cross perspective?
No, so they've had Wimpy UK for quite some time. I don't think that brand ever really had much traction, and they haven't been able to create traction from it in any large way over the years, so I guess that's the risk. But this seems to be something that's a little bit chunkier. And Henry, off the top of my head, the earnings contribution from the UK in time to come?
It's going to add around 5% to earnings growth over the next 5 years. So in 5 years' time, we think that around 20% of 15% of their profits will come from GBK itself, and then 20% will come out of the UK. Yeah.
That's quite significant, but obviously from a valuation perspective this makes us nervous because the PE does look a bit expensive at the moment. Is this likely to change perhaps and hopefully see a re-rating in the future?
So you had a structural re-rating of this share that took place, I would guess, probably 7 or 8 years ago. I mean, I remember writing a research report when this company was R3.70 a share. You could buy it on a forward 7 PE.
Sure.
And of course now the rating has gone, you've had explosive earnings growth, but the rating's gone from 7 times to about north of 20 times now. So I think I've been a little bit frustrated that it's looked at a little bit too expensive in recent times. But I think that if they can deliver on this earnings profile, there's no reason. Well, I wouldn't say there's no reason, but there is reason to believe that rating could be sustained. And I think part of the trick with it is that the dividend cover of this company has been coming down for a number of years because they have the ability to generate so much cash, and hence, despite the fact that you're paying north of a 20p, you're still getting what we think is above a 3% forward dividend yield. And that's sustainable. That payout ratio should be fairly sustainable. So I think yield and the quality of the cash flows could well underpin the rating, and you could still see reasonable growth from these levels.
Mm-hmm. Well, let's find out now from our experts whether to buy, hold or sell famous brands. Henry, let's get your view. Buy, hold or sell famous brands?
So Gugu, famous brands does look expensive. It's trading on a blended forward multiple of around 22 times at this point. However, assuming that earnings do grow at a rate of 20% per annum going forward, that multiple does eventually unwind. And I think one needs to take into consideration that eventually around 20% of this business's profits will be earned in the UK. And hence their weighted average cost of capital is actually going to come down significantly, and that would then justify a higher multiple. So, perhaps not a raging buy at this point, but certainly as the business grows into that rating, I would argue that it is a long-term buy.
Sean?
I've been a bit frustrated in that this one's run away from us. So we've got some exposure in our business, but I'd like to have had more. It's gone from 100 Rand a share to 150. So I think from a timing point of view, I'd like to see the share price going sideways for a little while, so that rating can unwind to an extent. So I think it's more about timing for me than the investment decision. I think that over an extended time period, you will still be rewarded by owning this share. So long-term buy, but short-term, I'm kind of watching it for now.
And on the leadership element, are we still fairly confident? Kevin Hedderwick in charge of strategy, a new chief executive also recently appointed. But are we happy with the gentlemen that have been placed in charge?
I think the point to make is that Darren has been around in this business for a very long time. So yes, he's new as the CEO role, but he's not new to the culture. He knows this business backwards. So I think from that perspective, it should be a pretty smooth transition.
Fantastic. Well, we'll leave it there for today on Famous Brands. But a big thank you to both my guests, Sean Ashton and Henry Biddlecombe, both from Anchor Capital, giving us their perspective on the outlook and valuation for famous brands. Do join us again next time, though, where we talk more stocks.